Hello, everybody, and welcome to the monthly market memo for the month ending April 2025. I'm Case Eichenberger, the Chief Investment Officer with Retire Path Advisors. And in today's short video, we wanted to walk through some of the major market moving headlines that occurred during the month of April, and there really was no shortage of them. If you've been kind of paying attention here for the month of April, it's been quite volatile, but we'll get into all that and talk about some of the brighter outlooks for the stock market and some of the brighter outlooks we actually saw during the middle of the month when all the volatility was happening. So one thing we wanted to kind of start off with this was the key themes for the month of April was really a key theme for most of February and March was all the volatility around the stock market. And at one point in April, we did see a drawdown from the all-time highs for the S&P 500 of about 19%. That happened on April 8th when after Liberation Day, of course, that was the announcement of the reciprocal tariffs and other volatility that had occurred around maybe a slowing economy. And stocks were digesting this news very fast and fell about 19%. However, that is so far the low for the year. And what we do find through various research, things I've written on our website, which you can find out there, is that there are quite a bit of opportunities that do await you if you're able to, sit through this volatility, which as long-term investors is our job to do. And if you can look past this volatility, you do see a lot brighter returns out there on the horizon, if you will. What we're showing here in this chart is the 15% or more drawdown during various scenarios, right? The tech bubble, the trade war of 18, COVID, our 2022 inflation shock, when they fell about 15 to 20%, returns on average 1 year later, as I highlighted at the bottom, were up about 41%, again, an average return. So once you've kind of gone through some of this volatility, and we saw it in a very short amount of time, there is opportunities 1 year, 2 years later to really catch back up those returns and see a lot better returns. So this is something that unfortunately, does happen in the market. It's what they call the risk premium. In order to get those high returns for stocks, you do see volatility take place. But just looking past the volatility, you can get to profitable returns as long as you have, a couple year time horizon. And that's what we show in this chart here. There is opportunities out there. And I wanted to kind of drive that point home because that's really what we saw at the middle of April, right? The market so far has bottomed on April 8th. And since then, the S&P 500 proxy for the market, stock market, is up over 11% in just 13 trading days. So we saw a big move on April 9th when the tariffs were paused. We've also saw a little bit of volatility around headlines of maybe trying to get a new Fed chair out there. But we've seen several negotiation positive news come out and maybe certain items being exempt, right? And you've seen stocks scream higher here since the bottom, up over 11% in just 13 trading days. And we got one more day tomorrow. I'm recording this on April 29th to see if we can actually finish positive for the month of April, which will be the first time that's ever happened where the stock market fell 10% and would be up for the month. So we'll have to see if that happens. But for right now, it's still a good opportunity if you're able to maybe put some money to work at that point or just stay invested, right? That's what we preach here is stick to your financial plan that your Retire Path Advisor has laid out for you, because fast returns can happen just as fast as they fell to begin the month. So those were some of the opportunities that we did find in the market. Now, some of the questions I've been getting from investors and from other clients is, will the headlines continue to get worse from here? And the market or the economy slowing, maybe corporate earnings slowing down, what's priced in already? And yes, that's definitely possible. One thing I wanted to point out is with the absence of any crystal ball, of course, this chart looks a little busy, but what we wanted to show is just as an example, stocks tend, not always, but do tend to bottom before corporate earnings bottom and also before the economy bottoms. What I'm showing here is 2020 as an example, a great example. The stock market low is in, 13 months later, earnings for the S&P 500 bottomed. So again, the stock market is always looking forward to try to predict what's going to happen in the earnings cycle and what's going to predict what's going to happen in the economy. Again, you saw the same thing with the economy in 2020, right? Stocks bottomed. 3 months later, GDP bottomed. So stocks do a pretty good job of trying to get ahead of everything. And the point to make of this is stocks may have bottomed on April 8th. We'll have to see, right, to see where we end the year. But so far, so good. That means you could see a lot more negative news come out around corporate earnings and around the economy. Maybe unemployment goes up, et cetera. But stocks have already discounted a lot of that news and fell 19% right from the highs just in a few couple days. So the track record is pretty good there for stocks bottoming before everything else. So don't let the future news kind of scare you because it may get worse. But for now, stocks have bottomed, and that's something we will continue to monitor very closely for you here at RetirePath. And then the last question I get is, how are we at the firm managing your risk in this environment? Obviously, if you're an accumulator, you're probably a lot in stocks and you have, a really good job and you have a long-term time horizon that maybe you don't need a lot of other risk management tools in there. But if you are in retirement or nearing retirement, there's likely a lot of different risk management tools that we have in your account. Now, for one, bonds have helped. I'm showing here on the left-hand side of basically the bond market is the blue line and the stock market is the dotted green line, green line. As you can see, since the top, the all-time high on 219 through the bottom on 48, stocks fell precipitously about 19%, something I mentioned earlier. But actually, bonds were up over 1% during that same time period. So bonds really showing why you want to own them in this environment because they are a fixed asset. They do have fixed maturities for the most part. We own high quality bonds in here, and therefore about 1% is a good return compared to the stock market down 19. That is one very good risk management tool we use. Additionally, we also look to employ some funds that you may have in your account that do options hedging. Now, this gets a little confusing, but what I want to show here is just the blue line, which is an example portfolio of how this works, is without using bonds at all. It's another way to manage your risk, basically. Just think of it that simply is, we can manage the risk by using some funds that write options. Maybe they are buying protective puts and they are selling covered calls on the stocks they own. So basically, you get a much less volatile risk to return profile without having to be all in the bond market. So we always want to be diversified here at RetirePath, and that is no shortage of using the risk management techniques available to us. Bonds, of course, and then other maybe options writing as well. Now, if you have any questions, please reach out. We do approach the management of your complete financial landscape very closely as a trusted steward, advocate, and confidant. We're committed to you, the client. I know this month was very volatile. We have a lot of updates on our website, and you can always reach out to us with any questions. Of course, I'm always available as the Chief Investment Officer here. And we hope you have a great start to the spring, and we'll talk to you next month. Thanks again. Take care.